Weimar Germany's hyperinflation wasn't an accident. It followed a predictable pattern. A blueprint of political denial, money printing addiction, and collapsing public trust. The frightening part, many of those same signals appear in global markets today. Before the crisis, life looked normal, shops were open, the currency still worked, and people felt safe. Yet behind the scenes, a silent catastrophe was forming. Shop numbers reveal the scale. In 1914, bread cost 0.29 marks. By 1923, it cost 200 billion. Money lost value so quickly that people used banknotes as fuel. But the real mystery remains. How did an advanced, educated society destroy its own money without realizing what was happening? This episode opens the sealed box. What broke the system? Who triggered the collapse? Why didn't anyone stop it? Most importantly, could similar psychological and financial forces be forming again today in ways traders and investors must understand? The clues are hidden in behavior, confidence, and momentum, not in simple inflation charts. The story begins before anyone recognizes the danger, and ends with a lesson most nations have forgotten.
Before the collapse, Weimar Germany looked stable. The war had left the economy wounded, but factories were running. Trade continued, and the currency still functioned. Hyperinflation was invisible, slow, hiding behind political promises and reassuring headlines. But subtle cracks were spreading through the system. Three forces shaped the mark's fate: the German government drowning in debts, the Reichsbank struggling to fund operations, and foreign creditors monitoring every move. Together, they formed a fragile triangle. One break in trust would collapse all three. Early warning signs appeared. Government deficits increased. Money printing quietly accelerated. Gold reserves fell. Foreign investors demanded higher interest rates. Yet newspapers insisted everything was fine. Confidence held, until external pressure struck. Germany's economy sat on a fault line. With war reparations looming, political instability rising, and elites divided on how to respond, the financial system drifted toward disaster. This is where the story truly begins. A seemingly normal society stepping unknowingly into its own collapse. As war debts came due, Germany had no foreign currency to pay them. The government chose the fastest short-term solution: print more marks. Each new batch made existing money weaker. Slowly at first, then rapidly. In January 1923, France and Belgium occupied the Ruhr, Germany's industrial core. After missed reparations, this became the first major domino. Germany encouraged workers to strike in protest. Factories shut down. Production collapsed. Tax revenues vanished. Germany now had no income, only expenses. To sustain the strike and keep the government running, the Reichsbank printed enormous amounts of money. The key figure was Governor Rudolf Havenstein, who believed printing was patriotic and necessary. His policy unleashed a flood of new marks into the economy. Confidence began to crack. Prices rose. Businesses demanded more money to operate. Workers demanded higher wages as purchasing power fell. A dangerous feedback loop started forming. The crisis was no longer economic, it had become psychological. Momentum was now against the currency. This was the beginning of the uncontrollable phase.
The hidden engine of hyperinflation is now printing itself. It is the moment people stop believing money will hold value. When trust breaks, spending accelerates. When spending accelerates, printing accelerates. When printing accelerates, prices explode. This is the unstoppable loop. Weimar fell into that loop. Rising prices gives wage demand, gives more printing, gives even high prices. The system was trapped. Meanwhile, those with influence exploited it. Industrialists borrowed heavily and repaid in worthless currency. Foreign speculators shorted the mark. Ordinary families lost their savings overnight. By late 1923, the economy was in free fall. Prices doubled every few days. Workers were paid twice daily because morning wages lost value by afternoon. Shops changed prices hourly. Farmers rushed to convert money into anything real: food, tools, clothing. Before it evaporated, the government kept printing because stopping meant collapse. Continuing meant collapse. There was no escape. The crisis had transitioned from financial to psychological to societal. Hyperinflation had taken full control, and the mark had become a dead currency walking.
In the final phase, the currency disintegrated. Within weeks, the mark collapsed from 100 million per US dollar to more than 3 trillion. Hyperinflation had consumed everything: salaries, savings, pensions, businesses, and social stability. The country could no longer function. Panic swept across society. People fled money and ran toward real assets: gold, farmland, food, foreign currency, and shares of companies with physical property. Paper money became toxic. Holding it meant guaranteed loss. Yet a small group of people emerged as unexpected winners. Industrialists who borrowed early repaid with worthless currency. Savvy traders who shifted into hard assets preserved wealth. Foreign investors who positioned early made large gains. Their advantage wasn't special knowledge, it was the ability to recognize behavioral shifts faster than the public. The collapse ended abruptly when Germany introduced a new currency backed by land value. But the mark was beyond saving. A decade of economic instability had compressed into a few catastrophic months. The climax left the nation psychologically scarred and financially transformed.
Weimar's collapse left permanent marks on global financial history. It created deep distrust of inflation, reshaped central bank policy thinking, and fueled political extremism. The trauma influenced Germany's economic decisions for generations. The core lesson isn't simply that printing money is dangerous. It's that public confidence is the real backbone of a currency. Once trust breaks, no policy, interest rates, controls, or messaging can restore stability quickly enough. Collapse moves faster than institutions can react. Modern parallels appear across the world. Global debt is at record highs. Major economies rely on low interest rates and sustained deficits. Emerging markets such as Argentina and Turkey show dangerous psychological shifts, where people expect devaluation, spend faster, and push inflation higher. For traders and investors, the most important signal is not inflation itself, but velocity: how quickly money moves. Rising velocity paired with fallen trust is the same pattern that preceded Weimar's collapse. Watching behavior offers earlier warnings than watching charts. The past does not repeat perfectly, but it often rhymes.
Weimar teaches a haunting truth: money survives because people believe in it. When faith disappears, collapse is instant. In our digital, fast-moving world, confidence can break even faster than in the 1920s. Weimar was not the last hyperinflation. It was the first major warning of the modern era. The blueprint: denial, debt, political pressure, overprinting, collapsing trust still exists and can appear anywhere. It activates whenever a society believes that money can be created faster than real value. This episode ends with a question: if public faith is the foundation of every currency, what happens when the next global crisis erodes that belief at digital speed? In the next Finance Arcana episode, we explore the nation that escaped inflation only to trigger one of the greatest deflations in modern history, a paradox with lessons for every investor today.